NYSE suffers cosmetic problem on floor's data screens. Right. A cosmetic problem affected data displays at the New York Stock Exchange on Thursday. The issues did not seem to disrupt trading. Many screens, which typically show quotes and other information, displayed NYSE logos. Thomson Financial provides the data for the displays. It was not immediately clear if the glitch was linked to issues at a CenturyLink data center in New Jersey that controls messaging traffic for many financial firms. The failure of a chilled water pipe at our NJ2 data center has caused the temperature inside the facility to rise. Customers have been notified, and out of an abundance of caution, some CenturyLink clients have chosen to temporarily shut down non-mission critical equipment. CenturyLink said in a statement. An investment technology group, Darkpool, which handles more than 300,000 stock trades per week, was taken offline because of the problem, Dow Jones reported. So, another glitch. Really? How many glitches can we have before we realize that it's a little bit worse than a glitch? Moving on from there, we got bigger news, bigger fish to fry. Devaluation stunner. China has dumped $100 billion in treasuries in the past 2 weeks. On August 11th, China devalued its currency, and the next day got blown up. And in subsequent 3 days, the onshore yuan, the CNY, tumbled by some 4% against the dollar. Then, as if by magic, the CNY stabilized when China started intervening massively, only this time not through the fixing, but in the actual FX market. This means that while China has previously been dumping reserves as a matter of FX policy, after August 11th, it was intervening directly in the FX market, with the intervention said to really pick up after the FOMC minutes on August 19th. The same day the market finally topped out, and has tumbled into a correction since then. The result was the same: massive FX reserve liquidations to defend the currency one way or another, or the other. And yet something curious emerges when comparing the traditionally tight and inverse relationship between the S&P and the Treasury long end. The drop in yields has not been anywhere near as profound as the tumble in stocks. In fact, the 30-year is wider now than where it was the day China announced the yuan devaluation. This is huge. It's official. China confirms it has been liquidating treasuries, warns Washington. On Tuesday evening, we asked what would happen if emerging markets joined China in dumping U.S. treasuries. For months, we've documented the PBOC's liquidation of its vast stack of U.S. paper. Back in July, for instance, we noted that China had dumped a record $143 billion in U.S. treasuries in 3 months via Belgium. Really? Back and forth? Sorry, there's a helicopter flying over, leaving Goldman speechless for once. We followed all this up. We followed all of this up this week by noting that thanks to the new FX regime, which in theory anyway should have required less intervention, China has likely sold somewhere on the order of $100 billion in U.S. treasuries in the past 2 weeks alone, in open FX ops to steady the yuan. Put simply, as part of China's devaluation and subsequent attempts to contain said devaluation, China has been purging an epic amount of treasuries. But even as the cat was out of the bag, up for zero hedge readers, and even as, to mix colorful escape metaphors, the genie has been out of the bottle since mid-August for China, which, thanks to a steadfast refusal to just float the yuan and be done with it, will have to continue selling USTs by the hundreds of billions. The world at large was slow to wake up to what China's FX interventions actually implied until Wednesday, when 2 things happened. Bloomberg, citing fixed income desks in New York, noted substantial selling pressure in long-term USTs, emanating from somebody in the Far East. And Bill Gross asked in a tweet if China was selling treasuries. Sure enough, on Thursday we got confirmation of what we've been detailing exhaustively for months. Here's Bloomberg. This is just ridiculous, the amount that they have sold. I highlighted this part because it's the explanation of what it actually means to those who don't know. As we discussed on Wednesday evening, we do, thanks to a review of the extant academic literature undertaken by Citi, have an idea of what foreign FX reserve liquidation means for USTSs. Suppose EM and developing countries, which hold $5,491 billion dollars in reserves, reduce holdings by 10% over 1 year. This amounts to 3.07% of U.S. GDP and means 10-year Treasury yields rates rise by a mammoth 108 BP, Citi said in a note dated earlier this week. In other words, for every $500 billion in liquidation Chinese FX reserves, there is an attendant 108 BPS worth of upward pressure in the 10-year. Bear in mind here that thanks to the threat of a looming Fed rate hike and a litany of other factors, including plunging commodity prices and idiocentric political risks, EM currencies are in free fall, which means that it's not just China that's in the process of liquidating US dollar assets. Ooh, it's fixing to be a very interesting September. Here is the Bloomberg article. I'll just give you a look at it because it's quoted in, oh man, Zero Hedge. But anyways, that's all I've got for you right now. I want to thank you all for watching. God bless and carry on.